Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seymour interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seymour.
Welcome everybody back. Another episode of the Apartment Guys podcast. And this is a hopefully very special and unique episode for a lot of you. We have our lending team on the show today, Michael Salzman and Patrick O'Malley with Northmarq. And they are a huge, important part of what we do at Greenlight. They help us underwrite deals and check our, really check everything across our underwriting. But I think even more importantly, we've worked with them and closed a couple deals with them. And so they can help us very much in competitive offer situations by writing us a letter, a pre-qualification. And sellers are really concerned about that right now. We're going to get into that here in a minute. But Michael and Patrick, I'm really stoked that you guys agreed to do this. I know you're super busy and really appreciate you guys.
Well, no, thanks for having us on the show. We appreciate it. It'll be fun.
Appreciate it.
Awesome. So before we get started, kind of dig into the meat and potatoes here of the markets and the changing market and interest rates and all that stuff. If you would, guys, each just kind of give us a quick little background on you, your kind of how you got to where you are today professionally, and maybe just describe a little bit about what you guys offer and what you specialize in. Michael, you want to go first?
Sure. Yeah. So I came from a very different background than commercial real estate. I started my career out of college in the wealth management world. I was a financial advisor at both Morgan Stanley and Merrill Lynch. And, that's a great business for a lot of people. For me, I grew up around real estate, around commercial real estate specifically. And at the end of the day, I just wasn't finding wealth management very fun. And wanted to make sure that I was having fun, not just in my personal life, but in my professional life. So I'll never forget. And really the short version of the story is I called my dad in I think late 2011 and said, I'm going to quit my job at Merrill Lynch, and I'm just going to become a syndicator, and I'm going to go buy apartment deals. I'm going to go buy industrial deals, and just start buying real estate. And my dad said, well, that's, he gave me some advice. He said, that's a really good idea, except for there's sort of one big fatal flaw in your plan. And that is that you have no clue what you're doing. So before you go raise other people's money and risk really blowing it, why don't you either go be a broker first, or a debt and equity broker first, something that will get your feet wet so that you can really learn the specificities of the business and really know how all property types are valued inside and out before you go and put others money at risk. And he said, and by the way, look, those businesses, those sorts of brokerage lines can be lucrative. And if you're good at it, you'll make a lot of money and you'll be able to invest side by side with your investors, which, is important. And I know, it's something we talk about with Greenlight. You guys are always co-investing with your investors. And, similar to that, I wanted to do the same. So I became happily stuck in this business because it's a lot of fun. Mm-hmm. And, Patrick and I met at a prior firm where I spent 7 years, and Patrick even spent a longer time period there in a variety of different roles. Mm-hmm. But we sort of gravitated toward each other and, became a team. And there are a lot of teams in the investment sales world in our business, but there aren't really a lot of teams in the debt and equity space. And we're not really sure why that is, but we've always felt kind of through this process that's happened over the years. Patrick and I have been working together for about a decade now, and we've just found that we do a better job helping people together than separately. So that's sort of what's brought me to this place.
Cool. Yeah, and you guys as a team, you offer a lot of advantages to us as a client. I think being a team, because you got two pairs of eyes on each deal, each scenario. You've got, with you guys being mortgage brokers, you have so many options to pull from. So it's important to get all of those out on the table. And sometimes there's creative ways of doing things that maybe one of you sees and has a brainstorm on, and also just accessibility. Like, you guys are extremely available and accessible to us when we need you, and you're responsive in terms of, a lot of these situations. Most of them are situations where we are offering making an offer on a property and need a letter of quote unquote pre-qualification letter from our lender to qualify us as buyers, and things like that need to happen in a timely manner, and sometimes we're a little under the gun. And
sure.
Having the two of you on it gives us a lot of confidence that one of you is going to be able to help us, if not both of you, pretty quickly and efficiently. And so I know I've noticed a lot of advantages to your team structure, and I think it's great.
Good. That's awesome to hear. And it's actually three sets of eyes. We should be clear with the audience that we have a third team member named Jared Wiedmeyer. He's our transaction manager, and most days it feels like he does the real work. But and he's great at what he does. Cool.
Patrick?
Yeah, well, and actually, just to expand on that, I agree with all of what you're saying. I think in buy-sell situations, when you have to move, our job is to put you in a position to be able to make the best decision that you can as quickly as you can. And even more so now with where rates and where the market is, I think, you may not want to make your decision today, but if we can put you in a position to make your decision today on debt or on equity or on whatever that may be, just puts more power in your hands versus just waiting on the market to dictate what it is that you can do. So, my background is quite a bit different than Michael's. I've spent about half of my career in the loan servicing side. So a lot of my day-to-day was reading loan documents and working on lender borrower insurance, or working on specific loan requests as part of the day-to-day operations for owners and operators. And so it was we represented life insurance companies predominantly, and so we were a sub-servicer for life insurance companies, and it was very interesting because you had to know 40 different life insurance companies and what those personalities were and how they were going to look at a draw request perhaps, or whatever it may be, and just managing those relationships. I found that I really enjoyed it, and but servicing is kind of it's a thankless task, and I was really drawn to the production side. Michael's smiling. Servicing is a tough job. Drawn to the production side. I really enjoyed the analytical piece of the business, and that's really where I kind of focus my efforts. I'm a grinder. I will look at financials till the end of the earth, and I like the underwriting side. I like finding the right debt for a deal. I like that challenge, and I also really enjoy working with 100+ different lenders, or on any given day to make that happen for clients. And so I've been in the production space, on the production side, for 5-6 years in various roles, analytical roles, underwriting roles. And it's much like Michael. I'm stuck here. I enjoy the challenges. I enjoy the relationships. I enjoy the demand. I think working with clients, everybody has their own set of needs, and it keeps every day very different.
Yeah. I love that about this business too. It's just every deal's different, every client's different, every investor's different. And there's nuances to everything that keeps you on your toes. And it's exciting. It's an exciting business. I love, Michael, your emphasis on fun. I love that you put that in your, like, the top of your list of criteria for the work that you do, because I personally believe that work can be fun, especially when you're good at it. I think that's like kind of paramount, is having a sense of mastery over it. And obviously when you started, you didn't, but you knew, you could see the potential there for success and fun. And to me, this is a blast. I love what I do. I would be doing this if I didn't, if I wasn't making a living doing it. I think I'd still be doing this right now. I just think it's a blast. And listeners, like, this is a key part of your power team right here. Like, our guys, we talk to them daily. We email all the time, text all the time. And you want somebody that's committed to you, that knows your credit profile, knows your criteria, knows what your business plan is and what you're trying to accomplish. You want those guys in your corner. And so I would highly encourage you to, if you have a great commercial lender, awesome. Like, make sure you're nurturing that relationship and that you're getting what you need. And if you don't, like, Michael and Patrick are amazing. I can vouch for them myself, and they'd be more than happy to consult with you on your business and talk to you about how they can help. And one of the things that we've touched on a couple times, but that should be just clearly described, is Michael and Patrick at Northmarq, they're brokers, right? So they have access to literally hundreds and hundreds of lenders and different lending programs. And that means that, like I said earlier, you can kind of get creative sometimes and look at a few different ways to fund a deal that, may or may not fit into your business plan better than another option, let's say. So, they can go to local banks, they can go to, the agency debt route, Fannie and Freddie, and everything in between. So that's exciting for us to have Michael and Patrick, with their level of experience and knowledge and creativity, out working for us to find the best possible scenarios for us. And so, again, like, your power team is, you've got maybe your immediate team, like your partner and your, if you have an executive assistant like we do, that's your immediate team, like your core group. But your power team are your lenders, your attorneys, your property managers, your capital raisers, right? Your co-GP potentially. Those are all people that you build these long-term relationships with. And that's one thing you want to make sure you're aligned on, is your long-term vision. And you want to find a lender that's aligned with you and that knows the space that you're in really, really, really well, and knows what you're trying to accomplish and has your goals in mind and everything else. So Michael and Patrick have become an essential part of our operation. And as we're in aggressive acquisition mode, these guys are hooking us up with what we need to get in front of the sellers, to make them feel confident that we can close the deal. And another thing I want to mention real quick, and this will kind of get us going in I think the right direction as far as our conversation, is sellers want to know, like, a good seller that's being represented by a good broker, they want to know what kind of debt you're getting, how much you're paying for it, what your interest rate is, what your loan to cost ratio is, how much flexibility you have in your underwriting if rates go up, because rates are changing at the volatility is crazy right now in interest rates, and they go up and down. And so my dog is chiming in on interest rates. He doesn't like them.
Nobody likes them.
He doesn't like the new scene. But the reality is that things have shifted a lot in the last month. And for those of you that are listening, we're recording this episode on April 18th of 2022. And just in the last month, we went from a pretty stable, pretty predictable lending market to kind of craziness and spiking interest rates. Michael, we were talking before the recording that the 10-year has gone up. What did you say? 1.25 or 1.5?
Yeah, almost 125 basis points since January 3rd, which was the first day of bond trading this year.
Yeah. Have you guys seen that kind of spike before, like that? It just incredibly rapid growth before in interest rates?
No, not really. We were seeing interest rates slowly rising in 2018 and 2019 prior to the pandemic. It was an environment that the overall market felt pretty comfortable with. I think that the sentiment was that rates had to increase eventually, and that as long as they were increasing gradually enough that we knew which way was up and which way was down, that would be okay. But we are frankly seeing some dramatic changes in interest rates this year. And to make matters frankly even a little worse for borrowers, we've also seen an environment this year where credit spreads, the spread over an index where lenders will quote their pricing, have actually widened out as well. So we've had increasing rates and increasing credit spreads, and that's resulted in materially higher interest rates for borrowers.
Yeah, and it changes your underwriting completely when you're underwriting a deal. The other big one that's changed from my perspective is the loan to cost or loan to purchase amounts that lenders are willing to lend on. Seem to have cut back 10, 15 points on that.
And what really drives that is not so much about where the lender feels they're comfortable with from a loan to value or loan to purchase standpoint, but it's really about the cash flow that the property produces and whether or not that cash flow can support a loan of a certain size.
Yeah.
And what we mean by that at the end of the day is that lenders look at debt coverage ratios, and every time interest rates increase substantially, you lose some purchasing power, because if the property's rental growth is not matching the pace of rate increases or outpacing it, that means that you can support less debt service payments. So that's really what we've seen constraining leverage. So apartment buyers that maybe at one point were accustomed to 75% leverage as a pretty typical sweet spot are suddenly looking at debt quotes on the same properties, without much time having passed, and suddenly max leverage might be 65%. And it's really because of debt coverage ratios.
Yeah. Gotcha. So, our job as entrepreneurs in general, but specifically in this space and as syndicators and deal makers and operators is to pivot and change strategically with the changing conditions and be as proactive as possible. It's interesting though, because I think we're in this twilight zone right now where cap rates haven't responded yet to rise in interest rates. And, we had a deal that you guys helped us with and that we almost got almost exactly a month ago, that it was a 360 unit deal, $25-ish million. And we lost out in highest and best barely to the eventual buyer, and interest rates spiked right after they went under contract. They had $500,000 earnest money down hard, non-refundable on the property. And because of the change in interest rates, they backed out of buying the property, gave up their earnest money. And there were some other circumstances, I think, that contributed, but the underwriting just blows up. So when it came back to us, because we were offered the property next, we went back to our underwriting and plugged in new debt quotes or estimations, and it just completely changed the deal. It changed the deal on the purchase price by millions of dollars, and sellers haven't, in my opinion, from what I'm seeing, sellers have not changed their expectation yet of what they feel like they can get for their properties. Are you guys seeing that too?
Yeah, I mean, we are seeing that. Northmarq is also has an investment sales side to our business, and we have colleagues on the other side of the house that are apartment brokers. And so far, to your point, we really haven't seen cap rates change much as interest rates have changed. Now, that could be for a couple of reasons. First of all, it's happened really quickly, right?
Yeah.
So
Yep.
Cap rates don't necessarily change as quickly as interest rates do.
Yeah.
But in addition to that, we've found ourselves in what feels like this sort of new world where investors are willing to accept lower returns.
Mm-hmm.
And at the same time, everyone's really betting that inflation is real, right? And that it's going to continue.
Yeah.
So, you can't borrow at 4.5 and pay a 3 cap all the time.
Right.
But what we are seeing investors betting on is rent growth, so that maybe you're really buying a property at a 3, what we call spot cap rate today, based on where the income is today. But you think that sort of negative leverage scenario of paying a higher interest rate than your cap rate is only really going to last 2 years by the time you get rent growth. But what that certainly does do is it takes margin for error out of deals.
Yeah.
And there are fewer buyers willing to execute acquisitions where there's such little room for error compared to before. So
Right.
Whether or not that affects cap rates moving forward, we'll see. Our crystal ball's been broken for a long, long time.
Yeah, sure. It's been so hard to predict what's happening, but yeah, I get it.
Yeah.
Yep. What are your thoughts, Patrick?
Yeah,
Deep in thought there, I can tell.
Yeah, no, my thought is I think the turbulence is going to continue. I think everything that Michael has kind of summarized is fairly spot on. I think you can only pay negative ARB on a loan against your purchase cap rate for so long, and I think a lot of people are comfortable with the fact that this inflation is real. But it's a combination of things here that we're looking at with rents in many areas already being at kind of historic highs. And so how far does that inflation carry you? It's a challenging concept, I think, for a lot of investors out there, and certainly in the debt space, capital markets, it is as well. Michael and I, this is a topic of conversation for us every day, and we're talking about it with ourselves, with our investment sales team. And I wish we knew, but it will be the next. My opinion here is the next several months, hopefully shorter term. There'll be a lot of discovery here where things will maybe start to feel or act a little bit more normal. But at the moment, it's really day by day, deal by deal.
It kind of feels a little bit like when COVID very first started and so much of the debt market pulled back, and then all of a sudden everything was back in place and ready to go, and investors were back in, and we had the best year ever in 2021 in multifamily and single family, and volume and average price and cap rate, and however you look at it. Like you said, the crystal ball is really difficult right now.
Yeah, this would be so much easier if we knew it was going to happen.
Right. We'd make a lot of money too. Huh?
Yeah, and just to elaborate on that, I mean, lenders are very much firmly in the market, right? Yeah. It's just that lenders are being disciplined, and they're sticking to their underwriting and making sure that they're lending on collateral with cash flow that can support debt service payments. So this is a challenging time not just for borrowers, but frankly for lenders, because, if you're a lender and you have, let's say you have $2 billion that you have to deploy this year, it's pretty hard to do that when suddenly, all your 70% deals have to be 60% deals.
Yeah.
It means that you've got to find a lot more deals, and you've got to figure out how to be competitive, not just with other lenders, within your stratosphere. That might be the life co stratosphere, right? Or the bank space, or the CMBS space. And we work with all sorts of different types of capital buckets. But as a lender, you got to figure out how to get your money out. And yet it has to be in such a way that it's prudent. So I think, to Patrick's point, in the coming months, we're going to go through a discovery process where both buyers and sellers have to kind of figure out what assets are worth in a world with materially different interest rates.
Yeah. Volatility and et cetera. Yep. Definitely it adds more risk to, your average deal. Right. And so, our job right now, as the way I see it at Greenlight, is to find good deals that underwrite well in, with some serious stress tests on the debt side, but are deals that cash flow in place, that have some value add, maybe aren't spiked on rents yet, have rent growth plays. And I think, just thinking out loud, one of the ways that we'll likely pivot, as listeners know, and you guys know, we're in Columbus and Oklahoma City primarily. And I think that because we have our infrastructure there and our property management teams and construction management and et cetera, I think we're going to start looking at smaller deals, like smaller unit counts, going after mom and pop owners that haven't raised rents and haven't maintained the property, haven't managed it necessarily as well as it could be. And for the longest time, it was all, bigger. Let's, more units, the better. The problem with that is that's what everybody wants. And the bigger you get, the more bigger money sources you're competing with on the deals. And just here in the last 6 weeks, I guess, or so, we've been in highest and best 3 different times and lost all 3 rounds. This last case was due to an all cash offer, which is, I don't know if that's really the case, but it's kind of unheard of. In a $16 million purchase, almost everybody's going to use debt of some kind. But that just shows how much liquidity is out there, how much capital, big sources of capital, are chasing these deals. And so we're a boutique investment firm, and we need to pivot and figure out ways of improving our continuing to grow our balance sheet, continue to cash flow returns for our investors. And I think that some of these, like 50 unit, 40 unit, 60 unit type deals are going to be less competitive for us to get the actual deal. And we'll still have some opportunity because they're not being talked up by brokers or multiple offers or anything like that. So just a preview of, we might be bringing you guys some slightly smaller deals, but our 43 unit in Columbus, which is a 506C, so I can talk about it. It's 43 units, but it's a $9.5 million deal, which isn't huge, but it's $10 million on our asset or on our balance sheet. And that's good. That's, at the end of the day, that's what really matters. And it's not all about how many units you're buying. So Tate's stream of consciousness thoughts there. For you.
But I think your stream of consciousness is telling, right? Because as interest rates have increased so quickly, some investors ask themselves, is there going to be this big sell-off in apartments, right? Mm-hmm. And to have a sell-off, you got to have assets marketed, and then suddenly there are no buyers. But what we're hearing from you and what we're hearing from our other clients is that it's still tremendously competitive. Mm-hmm. I mean, you're almost getting deals, right? And you're still losing deals. There's someone there either willing to pay more or offer a deposit that goes, non-refundable right away, or offer an all cash offer. Bottom line is with higher interest rates, it remains competitive. Mm-hmm. And the question becomes, as a multifamily investor, what is your business plan really going to look like? Mm-hmm. It's not just about what do you pay for a property and what do you borrow, but where's the meat left on the bone to add some value. It makes everything a little bit tougher, mm-hmm. but a little bit more fun too.
Yeah. Yeah. I mean, this is where hopefully you thrive in circumstances that aren't necessarily easy, right? Like this business is never not hard work, in my opinion. Like, we work really, really hard. We work a lot of hours, and it's what I would call hard work, but it's, we mentioned off the top how, all three of us love what we do and love the challenge and love the adversity when it pops up. And I think that's kind of the attitude you have to take. Otherwise you'll just, you'll quit. I personally think that this is going to lessen the kind of the hype around multifamily investing. And I think there's going to be a lot of folks that are either barely into multifamily investing or trying to get into multifamily investing that might back off in this changing environment. And I would just encourage listeners, obviously you need to do what's best for you, but this is where, people get rich in downturns and recessions and changing economic climates. And this is where you can thrive and find opportunity. I'm certain that we'll look back on this time and go, yeah, that was, you could still buy stuff then that worked, that maybe you had to work hard to go get and negotiate, but it's still an opportunity and a window, in my opinion, to make hay, so to speak.
Yeah, that's right. I think you have to ask yourself, what period of time am I in this for? Mm-hmm. And with so much market uncertainty, if you're going to be in a deal for a year or two, that's a lot trickier. Yeah. And whereas if there's a property that you're looking to acquire, and you believe in the property and you believe in the market, and you believe in the location, a good property is a good property. It's just all about, at what leverage point, mm-hmm. and with what management strategy.
Mm-hmm, mm-hmm. Yep. Yeah. Well said. Awesome.
That's exactly right. That is exactly right.
Yeah. Right on. So, we've talked, I've shared from my perspective, like all the things that you guys help us with and do for us, the ways that you serve our team. I guess maybe explain to the listeners, like how you can help them. Assume, let's say somebody that's maybe in single family and is transitioning to multifamily, wants to transition to multifamily, or is already looking for deals in dollars. How can you guys help those folks out?
Michael, I'm going to let you take a stab at that one. I think that's a great question.
Yeah. So, we, to a degree, what's fun for us in this business is that we grow with our clients, right? And vice versa. And for, someone, for example, who has a single family housing portfolio, but they want to move into multifamily, and maybe they're looking at a 10-unit deal or a 20-unit deal, we're happy to help size up what that underwriting looks like from a lender's perspective. Mm-hmm. To me, there are always at least two versions of underwriting for the same deal. Mm-hmm. There's the underwriting for the sponsor based upon how they see their business plan playing out, the property playing out, the market playing out. But given that we work with specific different types of capital, whether it's life insurance companies or Fannie and Freddie or debt funds or bank and credit unions, we have a really good idea of how lenders are going to look at a deal and underwrite a deal. Mm-hmm. And that's where we can help. And, our team, at this point, we've been doing this for quite a while, and our team is a fairly mature team. in that there are only so many hours in the day. And, whether we're the best team to help the guy go from a single housing, family portfolio to a couple of fourplexes, I don't know. But what I would tell you is that we have a lot of really good young people coming up behind us in the business that really know their stuff. And if there's ever a time that we're not the right team for a project, we can certainly make some great introductions to make sure that clients are being served by someone who will really take a deep dive with them.
Yeah. And I think it's important to note that Michael and Patrick are commercial lenders, right? And most of the listeners know commercial property qualifies as 5 units or more is your commercial property. So do you guys loan on residential?
We don't lend on single family residential. We have done deals on occasion on single family housing portfolios where there's a good number of units in the portfolio.
Yeah.
But generally speaking, the multifamily properties that Patrick and I are working on are, at least 40 units.
Yeah.
Generally speaking.
Yeah. So, and listeners, like we talk all the time about why scale is your friend, why go bigger, all the amount of leverage that you get when you go bigger, the amount of growth that you get from a bigger asset is bigger, and so there's lots of reasons to look at bigger assets. Money's easier to raise, arguably sometimes, because the bigger sources of money are interested in bigger deals. So, that being said, can't remember where I was going with that, but it's something that you want to use the right lender for the deal, right? So if you're accumulating fourplexes, Michael and Patrick aren't your folks, because they're fourplexes, as you know, are residential properties and have different loan programs. If you're doing 10 units, 20 units, a lot of times those are joint ventures, and those are, you guys will lend on those deals, but
absolutely.
But like Michael and Patrick said, their sweet spot is going to be in the 50 to 400 unit properties, right?
Again, it's all situational, market dependent. We've been doing this a while, and we're always, I love the conversations. I love working with clients and having and seeing and being part of that team and with that growth. I think for me, it's one of the fun aspects of what we do here on the debt and equity broker side is becoming part of a team and seeing a group go from owning, a couple of 10 or 20 units to owning or buying a 200 unit building. It's rewarding for us to be a part of that, to kind of help support that business plan and that growth and achieve those goals. So, I think always happy to have a conversation and see where we add value. The thing for, we don't want to waste anybody's time, right? Yeah. We want to respect our time. We want to respect, take your time and everybody that we're working with. Our time is our most valuable asset. And, if we're not the right fit, we may not be the right fit, and that may just be the answer. But we can certainly provide some insight. And we've, if you're thinking about talking to a lender, we've probably talked to them 10 times. If you're looking at, a debt fund bridge loan, we know those lenders by name and have had drinks with them on several occasions. And we can kind of give you some insight. And that's, I think, a big value add that for us is just knowing these lenders and knowing how they're going to respond, and they answer our calls too. Northmarq is a pretty large platform, and so we carry a lot of weight. We have offices from coast to coast, and they know that, these lenders know that.
And that's an important note is no matter where you are in the country, Michael and Patrick can help. Like they loan everywhere. You mentioned growing with your clients. That is a huge part of why we're working with you guys closely. Is we have a very specific, what we call a vivid vision, which we got from the book Vivid Vision, which I highly recommend, about what we're creating in the next 3 years and how we're growing and what we're growing and everything else. And our power team is part of that vivid vision. And you want to create, whether you're talking to a broker, a lender, an investor, you want to create the vision in their head for what you're doing. You want them to catch the vision. So like, one of the things I'll say to a broker is, we have a goal of growing our portfolio by 500 units in this market this year. And we're looking for a broker to grow with us. That paints the picture that you're not just some one-off deal maker that's taking a stab at something and maybe not know really what you're doing. It paints a picture that you have ambition, you have resources, and you have the ability to grow. And that, people take note of that. It's something that sticks in people's head. 500 doors. Cool. That's awesome. That's like something I'd want to be a part of, or 1,000 doors, or whatever it is. Or whether it's, 20 million assets under management, however you want to measure it, it's important to have those enrolling discussions, as I like to call them, with the people that are part of your power team. You want them to know what you're up to, what you're doing, what your goals are, so that they know that, hey, we're going to dig in hard on this one deal. But if this one deal doesn't work, Tate, we're your guys, and we'll be there for you on the next one, and we'll get the next one, kind of thing. And
yeah,
it makes you so much more powerful as a deal maker.
For sure.
Yeah.
For
so
sure.
we really have a high level of appreciation for what you guys do. Chelsea loves you guys, and Carl too. So
love them.
Yeah.
But yeah, we can't emphasize enough that while we might not always be right for every financing project, right? We welcome the discussions. That's why this is fun for us, right?
Yeah.
And oftentimes we will be able to say, hey, we can really help you with this, but sometimes we might not be the right ones to see it through. Mm-hmm. And rather than not have that conversation, we'd love to talk. We'd love to offer whatever insight we can, and we'd love to, maybe be a part of helping a sponsor find who the right person is to see it through.
Yeah, it's perfect. So how would a listener reach out to you guys? What's the best way to get in touch?
Best way is always email.
Okay.
Always email msalzman@northmarq.com and O'Malley@northmarq.com.
Yeah. So M Salzman for the listeners, MSALZMAN.
That's right.
At Northmarq.com. Mark is spelled MARQ.com, and P O'Malley, just like it sounds, OMALLEY, O'Malley at Northmarq.com. We'll put that in the show notes. And if anybody needs any further contact info, you can reach out to me at investwithgreenlight.com. And, listeners, just a reminder, I remind you guys every episode right now that we're talking to anybody and everybody that wants to talk to us. So if you're an aspiring investor, active investor, capital raiser, looking for deals, etc., my Calendly link is open, and you can book an appointment with me anytime to brainstorm, do some kind of informal coaching almost. It's no strings attached. I don't expect anything in return. It's just something we do because we like to do it. And like Michael and Patrick, we want to see you guys grow and close on a 200 unit deal or 150 unit deal this year. And look, if you guys are listening and we're at the end of this episode, you've listened to the whole thing, you're invested and you're doing the things to move the needle in your business and to gain the knowledge and gain, in this case, the resources to get better and to get more powerful and to put more arrows in your quiver, so to speak. Michael and Patrick will make your offer shine, and they know how to do that. They know what to say. They know how to phrase things. They know how to, make it so that a seller can easily understand what you're doing. And that's so important these days. I can't emphasize that enough. So guys, any final kind of words of advice or words of wisdom for growing investor in the multifamily space?
Keep listening to this podcast. I got to say, I think this is a really cool thing that you're doing, Tate. When I started in the finance arena within commercial real estate 10 years ago, there were not many podcasts like this. And I can't tell everyone enough how important it is when you're trying to learn a business, just to play in traffic, right? Be in the mix, be a part of these conversations, and be an active listener, because it's amazing how much faster you can get through your learning curve by just being in the mix.
Yeah. Well said.
I totally agree. I've always been a guy where I've wanted to master my field and understand the ins and outs of every piece of my business before taking the next step. In fact, my last little story, I was an analyst for a long time, underwriter for a long time, and Michael really helped me kind of get to the stage of more on that true production role. And it's a hard thing I think everybody kind of goes through their own process, but I just really felt like I had to be a master of my field, master of my craft. And all these things take time, and things that are worth the effort usually turn into a positive for you. But I think I couldn't agree more with Michael, what he got led with. I think listening to this podcast and playing in traffic, you just got to be out there.
I love what you just said too about things take time, right? Like patience is an underrated attribute, in my opinion. Gary V, I'm a huge fan of Gary Vaynerchuk. He talks about patience all the time. And, I didn't get into apartments till I was 47. And, 3 years later, I guess 46. So, it's kind of, and we started really from nothing at that point. And now we're at, 35 to 40 million in assets under management. And so we broke the seal, so to speak, on that law of the first deal thing that people talk about all the time. But you just, like you said, play in traffic, make offers, talk to brokers, talk to owners if you go direct to seller, and just kind of keep your feet moving underneath you. And like Patrick said, good things are going to happen. So guys, I can't tell you how much I appreciate this. It was awesome. It was an awesome hour. Tons of takeaways for me. And, this was a selfish episode in a way for me, because we're trying to figure this out with everybody else and with you guys. And so it was, I got to learn a lot and ask a lot of questions that I had, and I appreciate it. So thank you so much for coming on.
No, thank you. The reality is we're all still trying to figure it out.
Yeah.
Patrick talked a little bit about being a master of trade, and the reality is none of us will ever be a master of our trade. So you got to get going, and you should strive to be a master of your trade, but you can't wait for it, or it'll never happen.
I love that. I just, I've been listening to this book called, I think it's Be So Good They Can't Ignore You, something like that. Or So Good They Can't Ignore You. And it's all about mastering your craft. A lot of times passion comes after you've mastered something or achieved some level of mastery. Like, you don't necessarily know that you love something until you get good at it. And I found that in this space, to be quite honest. And the better, hopefully, we get, the more I enjoy it and love it. But I think that's an excellent point. So we'll leave it on that, guys. Thanks again. Appreciate it. Listeners, thank you for listening to another episode of The Apartment Guys. If you enjoyed it, we love whenever you leave us a review, a rating on Apple Podcasts is where you need to do that. We're also on Spotify, but you can't leave a rating there. So, and we'll be back with you on the next episode. So thanks again, everybody, and take care.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.